This LOS is describe how the choice of amortization method and assumptions concerning useful life and residual value affect amortization expense, financial statements, and ratios. Okay, there's only one slide for this LOS because this is exactly the same as the slide for the LOS that talks about the depreciation expense. Now we're talking about amortization, so the choice of the method, straight line versus accelerated, how does it impact the amortization expense, therefore the net income? Then we look at the balance sheet, assets and equity, return on assets and equity, turnover ratio, and finally the cash flow. So recall, for the straight line, if we were looking at 10 years, the depreciation rate would be 1 divided by 10 equals 10%, okay? And if we're doing accelerated or double declining in that case, for example, we'd multiply by 2, so we'd have 20%. So we know that under the accelerated, our amortization expense is higher. Again, this is giving the star that in the early years or growing firm, because with the accelerated, you don't depreciate past the residual value. So later on, then perhaps the straight line expense is higher than the accelerated if you're already fully depreciated, okay? So if your amortization expense is higher, then obviously your net income is lower. So as goes your net income, so goes your R ratios, return on asset and return on equity are both going to be lower, okay? So if I have a higher amortization expense, I'm going to have a lower assets, correct? Because remember, I'm just going to do their T accounts again. Here's my depreciation expense, debit depreciation expense, credit accumulated depreciation, which is a contra asset account. And here's our cost of our asset. The balance is here. Normal balance is a debit. And cost minus accumulated depreciation gives us our net book value. If I increase my depreciation expense, I'm going to increase my accumulated depreciation, and I'm going to decrease my net book value, okay? So with my lower assets, okay, I'm going to have a higher turnover ratio, okay? Now, remember, I've got lower assets, but you can see the ROA and the ROA is lower because, as I mentioned, as goes the income, so goes the R's, all right? That's the way to remember that. And assets equals liabilities plus equity. If I have lower assets, then obviously I have to have lower equity, and that's true because it's coming through that I've got the lower net income, all right? And the important thing, depreciation and amortization are non-cash expenses, so our cash flow is the same. And that's the only slide for this LOS. Thank you.